Hi, this is Ken Boyd. This is the website accountingaccidentally.com. And my latest post here, warning, do you know your fund's beta? And the reason for this video is a continuing trend that I see in the markets, which is tremendous volatility. So I make the point here that the volatility we see in the market is just about historic, huge daily swings in prices of stocks and stocks indices, 1, 2, 3% a day. And that can be pretty unnerving. But there's a statistic you can use, and if you know the statistic and how to use it, and how to use it to evaluate your own investments, it can give you some peace of mind, and that statistic is called beta. So I'm going to hit continue reading, and we'll continue on with the blog post here. So let's talk about that recent decline. Well, the S&P 500 is an index of the 500 largest stocks that trade on the exchanges. It's a very common index that we use to judge what's going on in the markets overall. So you'll see it pull up here on Investopedia. And I make the point that the index has declined about 10% since early May, which isn't the end of the world, but that's a meaningful decline. The problem is not just the decline, the problem is the roller coaster effect along the way. Big ups, big downs as the market moves. And there's another measure that I wanted to point out that gets a little more specific, which is called the VIX, V-I-X, which is the ticker symbol or the stock market symbol for the SIBO Volatility Index. And this index was created by the Chicago Board Options Exchange, and it has to do with stock options because we have stocks and then we have options trading on stocks. So I say here in this paragraph, all of the S&P stocks have options that trade on each stock. The option gives you the right to buy or sell a specific stock at a specific price and, in fact, for a specific time. So an option is a way to speculate on stocks. And I bring this all up because options are an indication of what the overall stock market's going to do. In fact, options more specifically are based on the expectation of what investors think stocks are going to do in terms of price. If the stock's expected to be volatile, the option is more likely to generate a profit. In other words, you have to have big swings in profitability for options to be profitable. If you don't have volatility, options aren't as profitable. You need to have volatility. So the VIX is an indication to a lot of people of expected market risk in the future, and as Investopedia describes it, an investor fear gauge. And lately, the VIX's value has fluctuated wildly. So I make the point here that we can agree that the market's volatile. And now the point is, well, what does that mean to you and to stocks that you own? And I finally get to the point here of explaining what beta is. And beta is a measure of your individual stock's volatility in relation to an entire market, or, for the purposes of this post, a mutual fund's volatility in comparison with the overall market. And what I'm going to do is go down here and pull up an example here as I talk through the post. So how do you measure beta? Well, I give you 3 examples. If IBM, for example, moves more than the overall market, that stock would have a beta of more than 1. So if the stock goes up 10%, your stock might go up 14%. The same is true on the downside. If the stock goes down 10%, your stock would go down more than 10%. On the other hand, if your Microsoft stock price, that's hard to say, moved less than the overall market, it would have a beta of less than 1. So stock market goes up 10%, your lower beta stock would only go up 7%. Same is true on the downside. Stock goes down 10%, your stock would go down less than 10% because the beta is less than 1. And finally, if your stock moves in exact correlation with the overall market, we give that a beta of 1. So we can use that intelligence. And I say here, it's all about high risk, high potential reward. If you're not comfortable with a lot of risk and volatility, you might look for a stock or a mutual fund with betas of less than 1. If you're a risk taker, like a skydiver or a person who rides a motorcycle without a helmet, you'd want a beta of more than 1 because you're willing to accept more risk in exchange for potentially having a higher reward. So let's take this concept of a beta and let's apply it to your mutual fund. So I picked a very popular mutual fund, which is Washington Mutual Investors. I'm going to click on ratings and risk. And what we see when we go to risk measures is that the beta for Washington Mutual Investors is 0.9, which means that if the market goes up 10% or down 10%, Washington Mutual would only move by 9%. So its beta is a little below the overall market. So what I'd like to suggest is that you can use beta as a way of measuring the volatility of any investment that you own, whether it's a stock or a stock mutual fund. Now, to wrap this up, one last thing that I did was to say, okay, what if I was to go out and Google low beta mutual funds? What would I end up with? And what I ended up with in the article that's pulling up is 2 types of funds. The first fund was a mutual fund that had utility stocks. Now that makes sense that they would have a low beta because utility stocks are steady and predictable. We all use electricity or gas, so utility company earnings are pretty predictable. Therefore, the stock price has less volatility. It makes sense. The second type of low beta mutual fund that you see in this article here is for a mutual fund of REITs, R-E-I-T, real estate investment trusts. Real estate REITs buy and manage property. There's less of a connection with the overall equity market. Therefore, there's a little bit of a disconnect between the performance of a REIT, a mutual fund that contains REITs, and the performance of other mutual funds that contain more stock. So what I'd like to suggest here to wrap up is that use your knowledge of beta to select mutual funds with volatility that you can live with, whether you like high risk or low risk. And checking that beta can give you some peace of mind. So get used to looking at the beta of the funds that you own. So that's as far as we'll get on this post. Remember that if you go to the Work With Me page here on my site, accountingaccidentally.com, you'll see links to Accounting Ed where I can create content for you, blogs, articles, and web pages I write, webinars coming up, and also speaking. And I will wrap up by jumping to accountinged.com, the training academy, where we have an online trading academy with gamification and other things that I think is very useful. So accountinged.com, the home page to get our online trading academy. Thanks very much for watching, and we'll see you next time.